Hello, welcome to the June market update. I'm Tony Marlette Jr. at Brookside Tax and Financial Group. Just a reminder, as always, if you call our office or go online and schedule a meeting, not only will your strategy session be at no cost to you, but you can also pick up a complimentary copy of one of our books on retirement planning and estate planning as well. So in May, we continued to see volatility. That volatility, though, did lead to a positive month, ever so slightly, thanks to a rally in the final week. Interestingly, we have seen 54 days this year in calendar year 2022, where we have had a 1% swing in either direction. And total in year 2021, we saw 55 days of that. And that's as of May 31st this year. So that just illustrates the volatility that we have seen and that we continue to see and that we expect to see as well. Most companies in the S&P 500 have reported first quarter earnings. Of those companies that have reported, 77% of them have beaten expectations, which were already pretty healthy to begin with. So again, this is not an issue of companies being weak. This is an issue of some extenuating circumstances. Earnings continue to rise. Stock prices continue to fall, which is creating some value. Stocks are cheaper, if not necessarily cheap, and valuations on many companies are back down to about the 10-year averages. So again, we're seeing some value here, as we've talked about in the past as well, which could create some opportunity. There is optimism for continued strong earnings based on company reports and outlook as well. Bonds were down year to date, obviously still worse than the overall market. They were positive in May as well. If we look forward, inflation really is still the key. Even when we talk about interest rates, if inflation starts to trail off a little bit, that's going to lead the Federal Reserve Board or the Fed to act less and be less aggressive, which would help the economy and help the earnings, which is good for the consumer because people go out and spend more. The opposite could be true too. If inflation continues to rise, the Fed is going to act more aggressively, and this helps curb spending and growth and could be a recessionary indicator as well. If inflation has indeed peaked and we do avoid a growth decline, this could lift market conditions as well. Don't forget, with anything that we talk about, there could be new fears coming that we're not even aware of yet. So leads us to our final point here about not overreacting. The way to combat these things is to make sure you have diversification. Your investments should meet your overall goal, strategy, and time frame. I use the example with clients all the time. Most people don't sell their homes that they're living in based on what the real estate market is doing. They live in their homes as long as it's needed. They downsize when necessary, or they upsize when necessary. Your investments should be treated the same way. You should be allocated consistent with your overall goals, strategy, and time frame. Work with your financial professional on this. Of course, you can give us a call at the number on your screen. Visit us online. From all of us at Brookside, we thank you for working with us.